Hello, everybody. My name is Daniel Prince, and I'm the host of the Once Bitten podcast. This is a podcast focused on Bitcoin. It's my mission to interview as many people as I can around the different aspects of Bitcoin and help people understand exactly what Bitcoin could mean for them and for their families and for their future. I hope you enjoy the show. Thank you so much for listening. Hey guys, thank you for joining me on this latest edition of the Once Bitten podcast, another one in the series of the Wall of Content. And joining me is the force of nature, Greg Foss, who's come out of left field with 30 years of trading CDS, credit default swaps, under his belt, and other fixed income and other products as well, which you will find out about in this interview, and taken the Bitcoin world by a little bit of storm. And a big character on Twitter, started calling out Peter Schiff and all of those shenanigans, which is great to see as well. So I hope you like this interview, and Greg, thanks for coming on. Really appreciate you doing that, and it was great fun. Before we get into the show, of course, make sure you head over. If you're in the UK, coinfloor.co.uk/bitten. If you're in the US, swanbitcoin.com/bitten. If you're across Europe, relay, relai.ch/bitten. These companies are helping you stack sats in a very sensible way. And once you've got these sats, you need to take control of them. Put them on a hardware wallet. You can use the Bitbox O2 Bitcoin only edition hardware wallet. You can find that at shiftcrypto.ch/bitten. That will get you a small discount. So there's not much more to say. I really hope you guys are enjoying this wall of content. This is like the 9th or 10th in a row that I've released. I've really enjoyed doing them. One day I will run out of content, or maybe I won't. Too many plebs to speak to in such little time. Enjoy this interview with Greg. Thank you everybody for listening, liking, writing reviews, and submitting whatever you do. Really appreciate it. Enjoy this one with Greg. Greg, we're good, man.
Nice to be here. Thank you for having me.
Great to meet you. It's been great seeing you burst onto the scene and come on and do all the different podcasts.
Can I tell you why? It's just because I've only discovered Twitter in the last 6 months of my life. I had no idea what a powerful tool that was, and I was joking with you earlier, but the reality is I'm old, so old that this stuff is not second nature to me. So you find something like Bitcoin Twitter, and oh man, what a cool tool.
It's crazy, isn't it? Like you kind of, I mean, I see my kids and they're on Instagram and Snapchat and whatever else. Facebook, I just never ever liked. I just hated it. And then I'm a little younger than you, probably not a great deal. I'm 44.
Well, I'm 57, so that's enough. That's a lot. Yeah. a lot of delta right there.
Yeah. And when I've been on Twitter for a long time. If you actually look at my profile, a long time, and for ages, I didn't really interact with it. I didn't, it seemed like just another one of these platforms to follow Z-list celebrities and footballers and whatever else. But then once I found Bitcoin, and even then it took me a few years to even find Bitcoin Twitter. And then you just lurk for a while because you're just like, the fuck is going on here?
Well, but not only that, but the people they're just such an eclectic group and very, very passionate. And it's, I tell you, I've learned so much. And, I was in our business, we were chatting about this earlier. I was wed to the Bloomberg. That was my only tool, which is a beautiful tool for trading and communication and, all the functionality of the Bloomberg terminal. But man, you don't realize what's available out there. And then having graduated to this platform, you see the beauty of the social media, no question.
Mate, I remember the old Reuters machines. Remember those things?
Oh, 100%. Oh, yeah.
Oh, how bad were they?
Well, how about, I'll even go further. Do you remember the mechanical? So first of all, I started trading when some of the guys on the floor still used bond books because there was no calculators. There was not even bond calculators, and then they came out with the mechanical bond calculators. I forgot their names, but it was like a typewriter, a glorified typewriter that calculated accrued interest and principal based on price and maturity, et cetera, et cetera. But then Bloomberg stormed on the scene, and it just took the fixed income trading world by storm. It was such a beautiful invention.
What year was that? Do you remember?
Well, I started trading in 1988. I'm going to say it was 1993 that that Bloomberg first came, their first evolution. And the big thing about Bloomberg that a lot of equity traders don't really don't get is, like, charts and everything in equities were standard issue, but bond pricing, the calculation of duration, convexity, change price, change your yield, etc., for a given instrument, and then the graphical interpretations available on Bloomberg. Like, Michael Bloomberg was a genius, no question, and his invention revolutionized the understanding of fixed income pricing, and then revolutionized the trading because of the communications. He basically set up his own social network amongst fixed income traders around the world, and you couldn't trade bonds if you didn't have a Bloomberg. It was you were so materially disadvantaged. So then they brought in the equity side, and charts and equities and exchange listed things, but it started as a fixed income tool. And foreign exchange, probably right. You probably graduated pretty quickly your business, FX options and all that stuff. So it was, there's no question that he should have been a billionaire, was a billionaire, and developed inside of Merrill Lynch, right? And then he brought it outside because Merrill didn't want it to. If I remember the story correctly, Merrill didn't want to develop it or whatever, and Michael Bloomberg just said, "That's fine. I want to buy it. I want to take it and market it globally."
So joining the markets in 1988, that's just after this crash. We had a huge crash in 1987. What was
So
pulling you
so
into markets?
that was my graduating year, or sorry, my second. I did 4 semesters in a business school in the U.S. So in my third semester, October 1987, that was near and dear in my heart. But then 1988, you're right, there was the crash. But then 1988, my inauguration into the fixed income side of the world was starting with 14% interest rates, but more importantly, with the default of all the most Latin American countries, as well as lesser developed countries, that were all defaulting on their bank debt. So it was an exciting time to get your start in the markets, for sure.
So let's kind of frame that up for people. When you say countries were defaulting, like Latin America were
Yeah.
defaulting, like, how would you explain that to a kid?
So this is really a great question. So in the mid 80s, petrodollars were circulating around the global banking system, and the banks needed to find demand for their newfound loan balances, if you will. And they found the countries. Generally, banks weren't huge lenders to countries prior to that. But the global banking system decided that they were going to lend US dollar denominated debt, 5-year loans essentially, to countries that are termed somewhat pejoratively, but LDC, lesser developed countries. So those countries included Latin America, but they also included Vietnam, Philippines, Thailand, countries that had, that could be termed not developed world, but emerging world borrowers. And given the fact that these countries were borrowing in US dollars and required to pay back their obligations in US dollars, any fluctuations in foreign currencies materially impacted their ability to repay those loans. And sure enough, in 1988, a number of the countries actually defaulted on their loans. And Treasury Secretary Nicholas Brady out of the US had to bring a solution to the banking system that essentially allowed the banks not to have to write down the value of their loans to the trading level, because if they did, the entire global banking system would have been insolvent. And it sounds ridiculous, but it's true, because banks are so levered. When a huge write down like that occurred, their book value of equity would have been vaporized. It's simple accounting. In the case of the Royal Bank of Canada, where I got my start, largest financial institution in Canada, no question, I ran through the math. And yes, if we had to write down our loans to market, meaning from about the 100 cents on the dollar level that the loans were advanced at, the trading levels, although there wasn't huge volume taking place, was about 25 cents on the dollar. We had about 4 billion in total of these loans, and if they on average trading at 25 cents on the dollar, we would have had to write down $3 billion worth of debt. And our book value of equity was less than $3 billion. I know it doesn't sound like a lot of a big volume today with all the, throwing around trillions of dollars. But yeah, that would have meant Royal Bank of Canada was insolvent. Now, what they did very quickly was they were able to say, okay, Treasury Secretary Nicholas Brady came up with a brilliant plan where you would switch a 5-year loan into a 30-year obligation, and you would secure the principal, a material portion of the principal of the loan with zero coupon U.S. Treasury bonds. And that allowed you to not write down your debt to market and assume that your debt would accrete back to the 100 cents on the dollar because of the security of the U.S. Treasury zero coupon bonds. Brilliant solution. First exposure to what is this Ponzi called fiat. So
you've been falling down the rabbit hole since 1988, and you just didn't realize
well,
it.
here's the funny thing. Yeah, I've been looking for the solution. I just never, I just said, so very quickly, Daniel, I mean, so you say to yourself, my God, I'm coming here. I'm pumped. I'm working in finance, and the whole system's a farce. And I can't, I'm under 30 years old, or around 30. I'm not going to go to the newspapers, and I'm not going to, ring the bell and cause a bank run. But yeah, that's the facts that the Royal Bank of Canada, as well as all other money center banks globally. So Manufacturer Hanover, the precursors, Manny Hanny's not even around anymore, but Bankers Trust, Manufacturers Hanover, Citibank for sure, JP Morgan, all the global money center banks in the US, Royal Bank of Scotland, Lloyd's, you name it, overseas, everybody had the same problem. Therefore, Treasury Secretary Nicholas Brady, for the health, if you will, or the functionality of the global banking system, had to design this bailout. It wasn't a bailout as much as a restructuring. It was brilliant, but it caused you to question, if banks can become insolvent that easily, how do they maintain their level of credit quality or confidence? How does the public have confidence in them? And it's very simple. It's the implied backstop by governments. And how is that backstop funded if ever they had to? And it's the printing of fiat. So yes, since 1988, I said, this system is suspect. I don't trust the system, but I don't know what the solution is. And I didn't fall down the gold. I didn't jump immediately to gold. I understood the implications, but we know the shortcomings of gold. And by the way, there's other things that you can invest in semi-hard assets, certainly. But yeah, I've been questioning the fiat system for over 30 years.
And when Bitcoin comes along and presents itself, are you like, you just reach out, want to give it a great big hug, or does it take you a couple of... I'll tell you
how the story happened. So I very quickly, so I traded credit for 30 years, started on the sell side, meaning I worked for the banks, the brokerage houses in both Bay Street in Canada, Wall Street in New York. And then I went to the hedge fund side. And I lived the calamity of the great financial crisis, the hedge fund, from a hedge fund aspect. And luckily, through good risk management and smart positioning, we came through that quite well. And it turned out to be the defining trait of my career, where I was able to say, okay, I'm done with managing money. And I sort of tried to retire, but you can never really retire, right? I mean, I'm not sure how you feel about it, but once you get the markets in your blood, you live it. You don't love managing other people's money. That's a pretty tough It's a tough job. It's in order of priority. It's easiest to lose your own money. Then it's second easiest to lose a bank's money or an institution's money. And it's really darn awful when you lose money for clients and friends of family and people that have trusted you with their capital. So I said, okay, that's done. And I think I tried to retire in like 2015, and in 2016, um, I was approached by a gentleman from Montreal who, that's my hometown. I live in Toronto now, but my hometown's Montreal. And I'm a partner in 8 Irish pubs in Montreal. And I happened to run across him in a pub in Montreal, one of my pubs. And he's like, yeah, I'm into this thing called Bitcoin. And okay, I've heard of it. He didn't say he didn't say it because everything that's wrong with the fiat system. He just said, this is Bitcoin. And I said, okay, so show me some stuff. And he showed me one page. And as an engineer, this page absolutely blew my mind. And that page was from tradeblock.com, showing the blockchain in action with the blocks being formed, the mempool, the transactions taking place around the world. And I looked at this and I go, wait a minute, this is real. This is unbelievable. Like, this is functioning system, living, breathing in front of me. And then I said, and it's the anti-fiat. This is what I've been looking for. So yeah, I found it in 2016, and that's when I tumbled hard down the rabbit hole, no question. And I ended up investing in this company, and that company was called 3IQ, and we were responsible for bringing the first Bitcoin listed fund, closed-end fund, to a registered exchange in North America. Okay. So at the time, Grayscale still existed or already existed in the US, but it traded on the pink sheets. It's not a registered exchange vehicle. Our vehicle was accepted to trade on the Toronto Stock Exchange. After 4 years of fighting the regulators in Canada, we were approved to list that vehicle. And I'm proud of it because it enables Canadians to gain exposure to what I view as the most beautiful technological innovation that I've seen in the financial markets in 30 years.
So when you saw that site for the first time, was that like seeing that Bloomberg terminal for the first time?
You asked that question. It's exactly the same. It's like, this is, so I'm an engineer. I studied as an engineer, but never truly went into pure engineering. I went and did an MBA in the US, and I became a financial engineer. But I'm visual. I love to see this stuff. And yes, I saw it and I'm like, wait a minute. Yeah, again, Daniel, I was like, dude, this is not fake. This is not something, this is so real. It's not funny. And then I go into it. It's like, what? Decentralized? It's permissionless. It's divisible, scalable. It's like, it's the best thing that's ever come. And yes, I just went hard, very hard.
Man, that's awesome. Wow, what a path. That's so great.
Well, because you see, everything for me has always been about credit. And in 2007, 2008, or I get like 2007 through 2009, I really thought it was over, guys. I'm not kidding. I'm riding the train to work in the mornings. March 2009, I remember thinking, we are right there. It's about not just to unravel, it's about to end. Citibank pref shares trading at 25 cents on the dollar, dragging all the pref shares of Canadian banks down to that same level. And you're thinking, like, that the leverage in the system won't support this. And you're just like, is today the day? Is today the day when it finally breaks? And, people are getting margin calls left, right, and center. And it's not that you're selling what you want to, it's what you're selling what you can. And there was pandemonium in the markets. And 2007, 2008, I lived through it. We survived. I should say our fund survived, but also the system survived. But all the system did was transfer leverage from the financial system, the global banking financial system, onto government balance sheets. Very simple. So everything that caused the crash or the deleveraging and the unwind in 2007, 2008 still exists. It just happens to live on government balance sheets right now. So that's why I look to credit. I've always looked to credit, and I'm continuing to look to credit as the precursor of the next big unwind.
What signs are you looking for specifically?
So, well, you start in the plumbing. You always start in the plumbing of the system. So there's always things like, repo markets, the things, repo, TED spread, bank swaps, interbank freezing of, don't trust your counterparty. Everything
That's a
just
big one
happens,
for
right?
me.
Oh yeah,
Yeah.
man. It's just like, you just feel it. You're like, wait a minute. I used to trade with these guys and I knew they were good for their word. And now you don't know if the trade's going to settle. And if it does, do you have a contract out against them? Are you relying on them for some sort of contract that materially impacts your position if they are not able to fulfill their obligation? And it becomes a question of whack-a-mole. And you're just like, you just know this system, which is always built on leverage, is susceptible to the domino effect. One guy falls, causes another guy to fall. All of a sudden, the protection you thought you had evaporates because that's no longer a claim against a good counterparty. And yeah, you've lived it.
Yeah, that was the biggest red flag when counterparties would stop accepting each other's names at certain, if you did a foreign exchange currency options deal and you matched Goldman's with, I don't know, Sumitomo Bank, on a 4-month option, and Goldman turned around and say, yeah, no, we can't do that trade because we don't see Sumitomo as a good counterparty. Then you go and you try and find a switch, somebody that would accept both names, but you're like, all right, something's up then. Because what do they see coming down the pike that nobody else does with that particular counterparty?
Correct.
And what does that say about Japan, just in this example, and it's...
And imagine if you're not part of that system, though. You're managing a hedge fund that's, you rely on the liquidity that the street provides you, or liquidity they rely on you. It's all the amount of netting in derivatives that takes place it's wonderful until one of those nets don't balance or one counterparty doesn't stand up to it, and then it's just cascading, bang 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 down. And so that's the plumbing of the system, the dangerous things you see. It sounds, did you know, and I'll just replay the great financial crisis. You remember when Jim Cramer went crazy on the tube in CNBC? It was in August of 2007. And he's like, the Fed doesn't get it. They just don't get it. And he calls it a rant. It was the Jim Cramer rant. And he needed the Fed to come and raise rates. And everyone thought raise rates. They need to cut rates. And as soon as the Fed cut, everybody would assume that the party could continue. But what happened was the equity market assumed the Fed cutting rates was the tonic that the markets needed, and it rallied to new highs. But the credit markets still called baloney, okay? And none of the plumbing in the credit markets was working, yet the equity markets were going to new highs again, okay? And as a credit guy, you're just like, the equity guys don't get it. They're just so out of touch. And sure enough, with 3 months later, things were imploding. Bear Stearns, which was at $120 a share, was down, $50 a share, and eventually cleared to JP Morgan at $2 a share. But I remember one of the quotes was, as Bear Stearns stock trades, so trades the Dow. And it's sure enough, that was the case, because everyone was worried about Bear Stearns and then Lehman Brothers and the counterparty risk that, Lehman failed. And then suppose you owned default protection on Bear Stearns, but Lehman, you had bought the protection from Lehman. All of a sudden, that protection doesn't exist, right? Because Lehman's done. They're baked. And the whole system which relies on leverage and counterparty considerations. Yeah, it was absolutely destruction.
Let's go down the rabbit hole of a credit default swap.
Sure.
And what that looks like and how that come to be. And then we'll go another layer, which I think you'll probably enjoy going into.
Sure.
But let's start with that. Credit default swap. How is this thing structured?
Okay, well, let's start with who designed it. To the best of my knowledge, there was a brilliant young lady, a youngish lady. I'm going to call her young lady compared to me, Blythe Masters, who you guys may know Danny Masters from CoinShares. Do you recognize Danny Masters? Big Brit guy. They just Danny Masters just issued CoinShares stock on the some exchange over in Europe. But anyway, Blythe Masters, JP Morgan, they came up with the concept of credit default swaps, CDS, which essentially is insurance on a reference asset. Okay. For a given name. So you pick a name. It could be anything from a corporate borrower to a state borrower. And there's even country credit default swap markets. But all it is it's just like a credit spread is for a bond, in that if you take a 10-year bond and you compare that to a corporate bond and you compare it to the yield on the 10-year treasury, and that spread, which compensates you for mostly for credit risk, but also compensates you for illiquidity risk, call it liquidity risk, and other components, but those are the two main ones, credit risk and liquidity risk. That spread, which relies on a physical bond outstanding that trades relative to a US Treasury, can be changed into a contract that starts as a 5-year contract, doesn't need to actually have a physical bond behind it. It refers to a physical bond, but you can have tons of insurance contracts written between various sophisticated financial institutions that require ISDAs to trade the default risk, essentially the premium on that given name. And what you have more than anything is a market. Excuse me for a sec, if that's my phone. It's my daughter. Jay, can you tell Sammy I can't answer the phone? I'm on. So this is my daughter saying something to your daughter. Okay, Daniel, this is how it is supposed to happen. Your daughter wasn't able to start. So that's my daughter, Samantha. She's 19 years old and she's 20 years old and she's at university. She tried to FaceTime me. So I don't even know how to turn it off. I have an Apple Watch, but I don't even know how to turn it off. Okay, so
don't worry, none of that will be edited out.
Please don't. This is technology. This is so beautiful. Okay, so here's the cool thing. Credit default swaps were able to create entire markets and a very efficient 1 year, 2 year, 3 year, 4 year, 5 year tenors on default protection on various names. And what did it allow the world to do? It could set up credit indices. 125 names that go into high grade index based on 5-year CDS credit default swaps that are established in a trading market amongst hedge funds, amongst big institutional players. And it allowed credit indices to be formulated that weren't otherwise available to the market, because not every company has a 5-year, a 4-year, a 3-year, a 2-year, and a 1-year bond outstanding that trades as liquid as the credit default swap market. Okay. It's a beautiful invention. Warren Buffett, he disses it because Warren Buffett doesn't really understand corporate credit. Okay, so let's be honest about Warren. He's really, really good with equities, but doesn't quite grasp. He says, "Oh, CDS, that's like buying fire insurance on someone else's house and then going out and setting their house on fire." Okay, Warren, that's one way you can interpret it, but it's not even close to how it's used properly and how it's used to hedge and manage risk and create credit indices that thereby create new buyers for credit that otherwise wouldn't have existed. Okay. So yeah, the ladies at JP Morgan were brilliant in setting this up, and an entire market evolved and developed around the creation of these credit default swap products. They are for very sophisticated investors. You can't trade CDS. You remember the movie with Michael Burry, The Big Short? Like he wanted to short all this stuff, but he couldn't get ISDAs with his counterparties to be able to prove that he had the collateral and the wherewithal to participate in this mega game. I'll call it a mega game. It's much more than that. It's a mega risk management platform.
And where does the rating agencies fit into all
So
of
that's
this?
okay. That's all good. I mean, the rating agency, let's say they rate a certain bond. And when you need to come to market as a corporate borrower, you generally need to credit rating agencies, Moody's and S&P. Why? Because it's developed that way. There's investment policy guidelines that are set up on behalf of pension funds and large investors that say you can own a credit rating down to the level triple B, but as soon as it passes the level triple B, it becomes non-investment grade. Well, isn't that funny? Non-investment grade, they don't even consider the price, but anything below triple B becomes non-investment grade, or in my term, high yield, because it becomes double B and single B and triple C rated credits that are pejoratively called junk bonds or whatever. So the rating agencies still play that game. They get paid for these ratings, and generally they do a pretty good job of it. What the rating agencies really, really crapped the bed on was rating these structures that were leveraged super senior structures using CDS. And you got the alchemists in there that created all these different assets, these pools of structured super senior devices that allowed people to pretend they had triple A exposure. But even the market would tell you, oh, S&P and Moody's says it's triple A rated, the top level of the pool, but it's trading at treasuries plus 200 basis points. You're getting a single or a double B type of return for a supposed triple A credit risk. I mean, therein is the gig, right? Like, someone was wrong, and it was the rating agencies. Okay, it's very simple. Their analysis of what the true AAA, the top exposures, the top pools of these structures, was not AAA, and that's when things start to unwind, because people can lever this AAA tranche and using leverage, and then all of a sudden they get a cash call and they have to sell, and there's no buyers, and it all comes cascading down. And it starts with a rating that you could definitely call out as a biased or a misinformed rating of true risk. And why does that happen, Daniel? Really, quite honestly, it happens because rating agencies want to make money, and the underwriters want to make money, and the underwriters make money when they can bring product to market. And to bring product to market, they had to pretend that the top tranches of these structures were AAA.
And that's the incentive structure right there, isn't it? The fact that there are only two rating agencies.
There's three really. I mean, there's four. There was Fitch. I mean, Fitch battles for some sort of. They're good in certain areas that S&P and Moody's. But yeah, the big two were S&P and Moody's, and it's a problem. It's been a problem since. Here's the problem. It's even worse. Is you tell me that somehow they subjectively rate a company double B, or a risk double B, which is in their terminology non-investment grade. And we haven't even talked about price. What if the price is, or a yield equivalent of 60% per annum? I don't know. It sort of sounds like that could be investment grade to me, but because why? Because, at that type of return or anticipated return, there could be some investment qualities to it. This is what happens when you have subjective opinions on risk that do not carry any connotation to price or true risk return pricing.
And they're listed as well, right? Both companies, they're public companies.
So
the
S&P is owned. They're both owned by. They're within bigger conglomerates, correct?
So you have that incentive structure to make your quarterly numbers as well. It's the whole fiat
I'll even
Ponzi.
throw another one out at you. So all the guys that were working as credit rating analysts, they actually didn't want to work for the credit rating agencies. They wanted to work for the Wall Street bankers, right?
Right.
So what's their best way of getting a favor with the Wall Street bankers? Oh, well, I'll give you a good rating here, and maybe next time you have an interview opening for a credit structured product guy, do you think you could consider me? This is totally. Guys, this is maybe made up in the world of FOSS, but in the world of FOSS, I'll tell you that yes, that is definitely there is definitely some stuff there.
Of course, that in itself is human nature. That
Daniel, you don't want to work for a credit rating agency. You're second class citizen compared to the investment bankers, right? So what do? You try and you try and curry favor with the investment bankers so you can get a job there.
Oh man, so Did you see it coming? Like 07,
So the
08?
first, I did actually, and I'm not going to say I have these crystal balls, but the first major credit event that occurred globally actually happened in Canada, and it was a structure called asset-backed commercial paper that stopped functioning in 2007, almost over a year in advance of the true credit crisis, which was 2008, and then the bottom of in 2009, March 2009. But yeah, in 2007, a very material market in Canada stopped functioning overnight. And that was called the asset-backed commercial paper market, which was based on, lo and behold, credit default swaps of investment-grade US companies that were 5-year swaps packaged into 90-day structures for commercial paper that continually had to roll, because 90 days does not equal 5 years. You continually had to roll that 90-day. And why did people buy this asset-backed commercial paper? Well, because they were getting a whole 4 and 5 and 6 basis points per year more than bank-sponsored commercial paper. And what was the real math behind it? Well, these bonds or these structures that were trading at 100 cents on the dollar should have probably been trading at about 87 cents on the dollar, but the Wall Street investment banks were taking out 13 points. Okay, no kidding, 13 points of risk. So you do $1 billion of that, and what's 13 points or 13% of $1 billion? That's $130 million of fees for every billion that's issued into Canada. And they're saying, okay, and you'll get an extra 6 basis points, when in fact there should have been an extra 13 points on a 5-year. So call it like there should have been another 300 basis points in there, not 6 basis points. But where's the VIG? The VIG goes to the Wall Street underwriter. And who's the stupid one at the table? Well, it's the buyer. It's not. Wall Street will design anything for you if you're willing to pay the price. So these guys had this paper. There was 32 billion of it in Canada, and one institution in Canada owned half of it. The pension fund of the province of Quebec owned 16 billion of this asset-backed commercial paper. That's equal to 10% of their assets at the time. And the case stopped rolling overnight. The case stopped rolling. And that piece of paper went from 100 cents on the dollar right down to 80 cents on the dollar with very little trade, and bottomed out at around 25 cents on the dollar. This was calamity. This was $32 billion. In Canada, those are huge sums of money that lost 75% of its value in a matter of months, only because the market stopped functioning. A big player stopped rolling its exposure. And this is what happens in a leverage system. As soon as you stop rolling your exposure, other buyers are like, whoa, what am I missing? Much like you said about Sumitomo. Oh, what am I missing? If these guys are stopped rolling their exposure, what is wrong? And that was the precursor to the global financial crisis. So Canada stopped functioning even before the rest of the world. Now, no one cares where Canada is or what they're doing. We can barely find Canada on a map, but that happened in Canada. So yeah, it was scary in Canada. And one of the big things that scared the case from rolling their paper, that's the case of Dépôt et Placements Québec, that's the big Quebec pension fund, was it had exposure to US subprime. Now, in reality, it had about 2% exposure to US subprime. So out of $100, it was mispriced by $13 to begin with. So it should have been trading at 87. And then if you totally take out all US subprime exposure, it's down to 85 cents on the dollar. Okay, full stop. It traded to 25 cents on the dollar. And therein was one of our best trades I've ever made in our lives, because we were able to buy it at 25 cents on the dollar. There was so much of it. We were able to pick and choose what exposure we wanted. And eventually the restructured bonds did go back to 100 cents on the dollar.
Man, that must have been crazy picking through all of that.
I wasn't big enough. Our fund was like $400 million, and there was 32 billion. available to purchase at 25 cents on the dollar. Like all of it wasn't for sale, but it was like, and I had to recycle this stuff, right? And I'm like, oh my God. And so there's a story. So what happened was they got restructured into these notes, and you might appreciate this. I know you will appreciate this. They got restructured into these generic notes called MAV notes. JP Morgan, of course, and JP Morgan was hired because everybody in New York has a way bigger brain than Canada. So Canadians hired JP Morgan to restructure the notes that JP Morgan originally started selling into Canada. And they restructure them, and they're these generic tranches. But then there's certain things that don't fit into the tranches, including U.S. subprime exposure. They traded as tracking notes, okay? So here's a war story. So one of these packages comes up for sale, and they were called A1s, A2s, Bs, and Cs, where the tranches. Everyone knew the prices of those. Okay, bang, bang, bang. You bang out those prices. But then there's some of these tracking notes, and generally, you get to know some of the tracking notes. But there was this esoteric tracking note that it was included in this package that I'd never seen before. And I said, okay, well, look, I don't know what it is. There's $1.6 million worth of it, face value. I need to put a price on it because in bond trading, you need to have a price as a contract. So I'll put $25 on 1.6 million. It's not 25 cents on the dollar. It's $25 that I could have reached into my pocket and put on that contract. So I'm buying 1.6 million of exposure for $25 out of my pocket. It's not out of my pocket, but you get the gist. And I assume it's worth zero because I've never seen it. So I'm putting it into the system. We match the QSIPs up and everything. I go home that night. I say, geez, I better figure out what I just bought. Imagine if it's a lottery ticket. So I go home, and you can find all this stuff on the web. It's there. You just had to do your digging. And I do some research, and I'm like, okay, I see the QSIP. I look at it. These are Quebec immigrant loans. Okay. Quebec immigrant loans. I think I'm sort of excited. Maybe they're worth more than zero. And then I see they're guaranteed by the province of Quebec. And I'm like, what? I just bought $1.6 million of Quebec risk for $25. Okay. And it matures in 6 months. So there's a trade for you. In 6 months, I made $1.6 million out of $25. I don't know what the return on that is, but it's got to be like grillions of percent, okay? And it's only because you're in the game and you're playing, and someone just wants to get these off their balance sheets, and they just give me anything. And I did. I gave them something. I gave them $25 because I literally thought it was worth $0, and it turned out to be worth $1.6 million in 6 months. But here's the fun part is you go out and you're like, I better find myself more of these. Like,
I was gonna say,
yeah, okay, so but then you can't be too fancy, right? Because you go out and you have some to offer, but you're trying to frame it so you don't get lifted, right? So you're like, yeah, I just bought some of these. Let's make the market 10, 12, 10 cents on the dollar to 12 cents on the dollar. But really, I don't want to get lifted because anyone that knows the game is like, it sold to me at 12. And you're like, oh, Jesus, I didn't want to sell. I just wanted to buy, I wanted to frame the market. So anyway, it's a real game, right? And then you're trying out there and you're like, yeah, the bid works for really good size, but the offer is a little flaky. Like, and you've played this game before, right? Anyway, we were able to get more in, and all it is again, being in the trenches, buying stuff that's a fire sale, and you're putting capital at risk because you're not just buying that, you're buying other stuff that's not guaranteed to go up in price either. But to insert yourself in that game is absolutely, well, it's what makes capitalism work. It's because you have these forced sellers, or these sellers that are selling stuff. They don't know what they're selling. They didn't know what they were buying, and now they don't know what they're selling. And maybe their boss just tapped them on the shoulder and said, you know what, I need you to get rid of this stuff because I just don't ever want to deal with this stuff again. And therein lies opportunities in markets. And if I had been somewhat crooked, I would have taken that trade and not put it in my hedge fund. I would have just put it in my personal account, right? And just said, okay, well, here are these bonds. Let's just put these in Foss's personal family trust. I didn't do that. They stayed in the hedge fund, and the hedge fund was able to post, some gains based on that particular trade. But let me tell you, Daniela, that these are when you think the world's unraveling, when you're able to, people are just selling anything just to get it off their balance sheets.
Imagine how many just went unnoticed.
So some, it never goes unnoticed, because what happens is these are all the people that bought this stuff are short-term investors that think they own, as the rating agencies told them, something rated AAA, when in fact they're much closer to single B ratings. And then they're not even allowed to own them because,
Right.
oh, I was an investment grade buyer, and then the rating agency comes and tells me they're non-investment grade, so I need to sell. Isn't that ridiculous?
Mm-hmm.
And that's what happens. So, it doesn't go unnoticed. I promise you, like when someone says I hit the bid, if you put your hand out and you just happen to be the hand that gets hit by that fly, hey, you own some stuff. And chances are, if you're good at your game, you're buying it at the proper price. But sometimes you overpay. Sometimes you buy stuff you don't even know. And I did that in my career as well. I thought I owned parts of structures that were much I did the research and I'm like, oh my God, why did I just pay that? I'm retarded. And then you try and turn around and offload your risk. And it's a bit of an art. You can't panic sell. You just have to sort of say, yeah, okay, well, last trade was at 85. So I think the market's 83.5, but don't test the bid. I'd really prefer that you come in and be a better buyer, not a seller. You know what I mean? So.
Oh, yeah, the good old days. Yeah, all the games. And I remember actually, because the banks carry ratings as well, and which is still crazy, because if all of these banks are insolvent, as you came to realize many, many moons ago, I still remember Tordom, the great Canadian bank, Toronto Dominion.
There. That's where I started on my sell side.
Right. AAA rating.
Oh, yeah, all the Canadian banks and Toronto Dominion actually did something really well in the Latin American debt crisis. They actually did not have Latin American debt exposure. They were one of the only North American banks with zero Latin American debt exposure, because their chairman said, I don't believe we should be lending to these countries. And he was smart. And yeah, they were AAA rated. That's correct. But really, they're still 25 times levered to their equity cushion, 25 times levered. Even Toronto Dominion had their problems because they had lots of exposure to what's called TMT, telecom, media, and technology companies that were like CLEX and all these other companies that, you know how the CLEX story ended, right? And so that's banking. And why do they have that AAA rating? Again, Daniel, very simple, because of the implied backstop by the government of Canada, which was also rated AAA. And therefore, you're allowed to give your banking system a AAA rating.
And what's going on right now in Canada? Because this has just been a crazy year for you guys. The printing is
so we're off the charts printing. So let's refer to two things. First of all, I'll just say what's going on in Canada. We got smacked. Our energy sector used to be a source of pride. Now it's a source of hindrance. People will argue that our real estate market's way overvalued. I don't happen to think that's the case, but I don't want to argue about subtleties. But some of the biggest pillars of financial strength in Canada turned into weaknesses. Banks don't typically securitize much of their real estate exposure like they do in the US, and therefore are sitting on a bunch of real estate exposure right now that you could argue is, somewhat suspect. These big office buildings aren't quite as occupied as they might have been prior to the COVID. But what has really happened, and this is key, because let's look at the credit default swap market on sovereign nations. So Canada still maintains a AAA credit rating by S&P. Funny, or not funny, but strangely, the USA is only AA plus. Now, in the credit default swap market, the USA for 5-year default insurance or default protection trades at 10 basis points. That's a AA credit by S&P. So logically, if Canada was AAA rated, we all know that the spread on Canada should be lower even than the USA, right? Better credit, therefore less chance of default, therefore a lower premium to insure that debt. Full stop. Canada trades at 37 basis points in the CDS market. That's much closer to a single A rating, not a triple A rating. So who's right? Well, look, markets are always right. The S&P rating on Canada is wrong. You pointed out that Canada's debt per capita grew faster than any other G7 nation in the world in the latest COVID crisis. And in my opinion, the CDS, the default swap markets, are correct. And Canada has a real reckoning, okay? We are not the AAA credit that Pierre Trudeau, our prime minister, may even understand. I doubt he even understands what a AAA credit rating implies. I'm certain he's horrible at math. I mean, he's proven that time and time again. The default swap markets are telling you that Canada is a single A rated credit. So you'd say, what are other single A or triple B rated credits out there? And you look at things like Italy and Portugal, and their CDS ratings or levels are closer or sometimes even narrower than Canada, even though they have a worse credit rating. But what do they have that Canada doesn't have? And you know the answer, it's the ECB. The ECB will do whatever it takes to maintain the liquidity within the mid-European countries, the former PIGs. And, that's reflected in the CDS market, but Canada doesn't have that backstop. We have the Bank of Canada, but on an apples to apples basis, the country of Canada is just slightly more important than the state of California. The GDP of the state of California and the GDP of Canada, the country, are about the same. So put that in your calculator and say, okay, if you are a G7 nation like Canada, you don't have an ECB backstop, you have a government that just thinks that money can be printed ad nauseum, and I'm worried for my kids.
How does this unravel, man? Like that?
I know how it unravels. I think what you meant is, how does it solve itself? I know how it unravels, okay, because I've seen it many, many times. It unravels very quickly. Risk happens fast. It unravels because people stop rolling their debt. International lenders to Canada just say, hey, full stop. I don't need Canada. You're done, man. And Canada's like, well,